Good morning, class. This is Dr. Remy. It's very frustrating that I have to record this again and again. I don't know what happened to the system. But before we move further, let me quickly explain last week about Tessie. I'm very appreciative that individual of you watched the video. I'm very pleased about that. And you also make references to the video that you watch. That make the classroom discussion to be very interactive and also reflective because some of you refer to your experiences. This week, um, we are looking at the differences between the gross revenue, net revenue, um, retained earnings, and dividends. And I'm going to be taking it segment by segment. I'm going to be categorizing it into two different formats because they are major two type of business operation. Um, Businesses can be in manufacturing, it can be in services, providing the services. So there's a slight difference when you computing the income statement for the two. When a business receive income for either production or services they provide, that income is known as gross revenue. A typical example that I usually use, Remy, let's say Remy Bakery or Remy Holdings. We use Remy Bakery for production, we use Remy Holding for services. Remy Bakery bake for the whole month of March, from 1st of March to ending of March. Remy Bakery bake a whole lot of bagel that amount to 2 million for Yafapai College. $2 million worth of bagel was baked for Yafapai College for the month of March. Remy Odin produced services for Yafapai College for the whole month of March that were 2 million. Yeah? Those 2 million on each segment of business operation are gross revenue. For bakery, which is manufacturing, Remy Bakery will have incurred some expenses in purchasing flour, sugar, butter, eggs, oil, the baking products. Remy Bakery will have incurred the cost of oven. So Remy Bakery will have had people that work in the bakery incur expenses like electricity, water, transportation, packaging. On the other hand, for the services, Remy Holding will have incurred expenses like the cost of gadgets. Let's say computer were involved, phone were involved, photocopy, everything that need, Remy Becky will have incurred the services of the professional that he used, salaries, transportation. Okay. For the bakery, the cost of production is the cost of producing all the total bagel for the month of March. Let's assume that is 500,000. So when we less 500,000 from whether 1 million or 2 million that is received, let's assume 2 million that is received for gross revenue, 2 million. We less the cost of production, cost of flour and those butter, egg, yeast. We less that 500,000. That will give us 1.5. That 1.5 is known as gross revenue. Gross revenue. When Remy Bakery now deduct the cost of salary he pay for the worker, transportation, electricity, water, and packaging and everything, including the depreciation expense of the oven and other fixed equipment that were used. When we less the total of those expenses, it becomes net income before tax. I'm going to repeat that. Net income or net revenue before tax. Because Remy operates in Arizona, state of Arizona tax rate is 10%. The total expenses that we deduct is another 500,000. That gives you 1 million. That's net income before tax. Because Remy operates in state of Arizona with 10% rate in tax jurisdiction, the 10% of 1 million is 100,000. That means 100,000 is tax liability for Remy to pay to state of Arizona revenue. We less that 100,000, we have 900,000 left. That 900,000 is net revenue after tax. Net revenue after tax. But let's assume that Remy Bakery have other income. Other income from other investing in other businesses, interest income from certificate of deposit, or other income for financing activities. That anything that is received as income that is not part of the bakery activities, they're going to be added to net income before tax. I'm going to repeat that. They're going to be added to net income before tax. Let's assume is the total of other income is 200,000. We're going to be adding that 200,000 to 1 million, making 1.2 million. So when we want to assess the tax liability will be assessed based on 1.2 million to get our tax liability of 120,000. And we want less 120,000 from 1.2 million. It will be 1,080,000. That will be net income after tax. Net income after tax. If Remy Bakery should pay dividend, the board of directors for Remy Bakery, they say, oh, we approve 500,000 out of that profit to be paid as dividend to shareholders. Then we less that 500,000 from 1,080,000. We have 580,000 retained earnings. That retained earnings can be used in any way at the discretion of board of directors, either to expand the business operation, to invest in other business, to finance other business activities. On the other hand, which is services, net income of gross revenue of 2 million, less all the expenses, including depreciation and every amount of salary, total, let's say 1 million. We less 1 million from 2 million, we get gross revenue before tax. Gross revenue before tax. If there are any other income, we add it to get net income before tax. Then we deduct tax liability of 100,000. We have now 100,000 as net. That would be net income. 900,000 will be net income after tax. Should board of directors declare dividends of 400,000? 500,000 that is left will be reaching earnings. If board of directors does not declare dividend that year, that 900,000 will turn to reaching earnings, and Remy Odis can use that money to expand business operation, to invest in other business activities, to do whatever they want to do. They can put it in certificate of deposit that will return, and those money will be other income or extraordinary income that does not belong to the primary business operation. So there is difference between gross revenue, net income, retained earnings. There are two categories of net income. Net income or net revenue before tax, and net income or net revenue after tax. Know the differences. And the dividends is paid to the individual shareholders. This is where the double taxation comes in. You know that the business already paid tax on the net income before they take out the dividend out of the net income. When they pay those dividends to the shareholder has to declare it on their individual 1040, individual tax filing, as a capital gain. As a capital gain. We did that in 115. So, and they have to pay tax on that capital gain again, but at a lower rate. The tax rate of regular income tax you pay on your W2 is higher than the capital gain. So they have to assess the capital gain at a lower rate. They have to pay tax on it again, but at a lower rate. That is what they usually call double taxation. I hope you understand this. If you have any subsequent question, please reach out to me. My number is 928-717-7325. 928-717-7325. Thank you, everybody, and I look forward to your questions during the week. Bye.